Good evening, ladies and gentlemen. I am Abdulaziz Al-Sha'rawi, and I'm a Kevin Harrington Student Ambassador. New Hampshire Institute of Politics is a nonpartisan institute, and its mission is to educate, engage, and empower citizens to actively participate in the civic and political life of their communities and strengthen democracy. Could you please silence any devices that make noise, like cell phones? There will be a brief question and answer session following the talk. Please line up at the microphones located on both sides of the auditorium to ask your questions. I'm so pleased to be with you tonight, and to have the chance to introduce our guest speaker, Mr. Paul Mills. He is the senior representative at the International Monetary Fund. Mr. Mills joined the IMF in early 2006 and has worked on global financial stability, the US financial system, innovative risk transfer, climate change and financial markets, and Islamic finance. Mr. Mills now heads the fund's London office, focusing particularly on the euro area crisis, financial stability, and regulatory policy. Mr. Mills has a great understanding of the financial crisis issue and would discuss the lessons learned since the Lehman failure 5 years ago. As part of the Bean Lectures series at St. Anselm College, Mr. Mills' talk would give answers to questions like what we have learned from the financial crisis, what we have forgotten already, and what is yet to come. Without further ado, please join me in welcoming Mr. Paul Mills.
Thank you for your welcome. I'll get the admin out of the way. First to say, everything I'll say is a very personal view. It must not be attributed to the IMF because it'll be far too radical. Also, if you hear me say anything partisan, you misheard me. I will try and be assiduously neutral and stand back. Also, please don't think that it's all very well for a Brit to come across and lecture you Americans about how to do things, because some of the things I'll say that need fixing in the US, we've got as big a problem, if not worse. So don't think that this is just a lecture from the other side of the Atlantic. If you want to locate what I'm going to say, I'll come from what I'd christen a sort of debt skeptic perspective. For about 25 years since my PhD thesis, I've been sort of writing and thinking about the problems both the US, UK, and other countries get into because we have a debt-based financial system. This sounds somewhat radical because we haven't had a non-debt-based system for a while. And so this crisis is just sort of par for the course for me. This is how the system tends to veer and requires subsidy, bailout, inflation, and so on as a result. If you want to locate me in economics, I would be on the sort of finance end of things and see everything primarily as finance driving the real economy, not the other way around. Amazingly, macroeconomics hardly has a role for finance. If you go to the Fed's macroeconomic model, they hardly have a financial system in it. And macroeconomic textbooks don't really understand why banks exist at all. And so to the traditional economist, what I'm going to say is sort of incomprehensible. The financial crisis shouldn't have happened. And what are we worrying about? From my perspective, finance drives the real economy, and you just got to think about balance sheets for government, households, companies, and then how banks and other intermediaries get into trouble as a result. And that drives a lot of what goes on in the real economy. If you want to associate names with that, there was a great economist in the 1930s that explained the Depression as a debt deflation problem. He was called Irving Fisher. Then Hyman Minsky in the 1970s and 80s took that on. There's one or two analysts now who are too radical to be mainstream who would be where I'm currently at. So what I'm going to try and do is just tell you what's going wrong with the system. And if anything, this is a recent cartoon of the debt negotiations and the solution that has come about, which encapsulates what I'd say has happened since the crisis, that we had to throw an enormous amount of money and stimulus at the problem, and we've just sort of postponed it, and we keep postponing the resolution, partly through fiscal stimulus, partly through the Fed having interest rates at effectively zero, and then quantitative easing, sort of printing money just to keep the system going. So one day, the debt is going to get so big or so unfinanceable that a crisis won't be ultimately resolvable or be able to be postponed. But that day hasn't yet quite arrived. So I will very briefly go through the familiar causes of the crisis and then what happened with policy. I'll give you a sort of overview of where we have got to since then and how the US economy is sort of recovering, but in a tentative manner. The things that we've learned, what worked and what caused the crisis, but then what we haven't learned, what we've forgotten already, and what might be around the corner. So this is familiar stuff. What caused the crisis? Essentially, in the run-up to 2006, 2007, we have a system of international finance where a number of countries, the US, the UK, Spain in particular, were importing capital heavily, primarily to finance housing and consumption. And a number of countries were exporting that capital, primarily China, Middle East, Germany. But they were channeling that money across largely fixed exchange rates, particularly China into the US, and into debt instruments. So this was savings channeled via government bonds or via mortgage-backed securities. And just to give you my debt skeptic perspective, anything that involves debt across fixed exchange rates is always dangerous because there's no price mechanism to adjust when there's a shock, when there's a misvaluation. That was combined with very lax monetary policy in hindsight from both the Fed and other central banks because inflation was low. We were still enjoying the fruits of the global economy, expanding the labor pool, and that has kept wages structurally lower and inflation very benign. And so central banks were able to keep interest rates low and thought that they had got control of inflation. We became complacent about financial risk. So we allowed banks to run with very, very little capital. We allowed them to extend what we call the maturity mismatch on their balance sheets. That means that when banks operate, they borrow short and lend long. Or in the case of Wall Street with Lehman Brothers and others, it was borrowing short-term in the money market and buying long-term securities that then had to be used as collateral for that short-term borrowing. Just as an analogy that I like to use, it was as if we were in a town that hadn't had a fire for 10 years. So what happens when the mayor comes along to cut costs? They get rid of the fire engine. Then to cut costs more, they get rid of the fire extinguishers. And they still haven't had a fire, and they cut costs more and more. But make the system efficient. It's very cost effective, but very risky. For when a fire does break out, there is a conflagration. So we were just economizing on the insurance or the risk buffers in the system up until the crisis broke. Perhaps the most shocking statistic I'll quote today is that when the crisis broke, Deutsche Bank was leveraged 70 times, 70 times. That means that its assets were 70 times its capital. That would be like buying a house with 1.5% down, but then going bust if the house ever fell more than 1% in value. That's how leveraged a $2 trillion balance sheet had become in 2007. Combined with that, we had a lot of credit extended or held outside the banking system with very little regulation, particularly in the US. That was Fannie and Freddie, hedge funds and others. But of course, there was a political desire for low interest rates, cheap credit, lax financing standards. So there was a bipartisan push in the US from the mid-90s to get home ownership up. Home ownership had been relatively flat at about 65% in the US, and a lot of encouragement was given to enable people to buy their houses, and that meant loose mortgage standards. And you managed to get the home ownership rate up to the exorbitant heights of 67%. Sorry, 69%. It's now back down to 65% with all the foreclosures that have gone on. So the bottom line is that the system became very levered and very illiquid. That means that it's holding very little capital and doing a lot of maturity transformation. There's very little cash on hand if things go wrong. So the familiar tale is that from just at the end of 2006, there were some rumblings in the subprime market in the US, and that started to ripple through in terms of losses in mortgage-backed securities in 2007. Then that the waves of that grew late 2007, 2008, and then finally you get March 2008, Bear Stearns needing to be rescued, one of the major 6 Wall Street firms at the time, and it continued on as confidence in the system ebbed away, leading up to the need to bail out Fannie and Freddie in September 2008. Then Lehman Brothers was allowed to fail in October 2008, forcing the rescue of AIG to save Goldman Sachs. And so you had that sort of ripple from the subprime sort of delinquencies rising into Wall Street and so on. So what did policymakers do? They bailed certain firms out, not Lehman Brothers, but others. They then put interest rates at effectively zero for a long time. So we've had interest rates below 1% in the UK, Japan, the Euro area, and the US now for 4 or 5 years since the crisis. This has been unprecedented in history. We have 300 years of data in the UK for interest rates. The 10-year yield on government bonds hit 1.4% last year. The lowest it had ever been before that was in 1817, and it had hit 2.1% then. So this is sort of historically absolutely unprecedented. We then had lots of emergency liquidity and guarantees thrown at the system by the central banks. So at its peak, the Fed was providing $1.8 trillion of emergency liquidity to the system through swaps and other things. And not just bank deposits were guaranteed, but money market mutual funds were guaranteed. So in the US, you have about $7.5 trillion of bank deposits that all of a sudden were guaranteed in their entirety by the Fed. But then they also then added the $3 trillion of money market funds to make sure there wasn't a run on those. When it got really bad, there was the famous meeting between the Treasury Secretary Paulson and the 9 heads of the Wall Street major banks, and he forced them to take $25 billion of capital each to make sure that there was confidence in the system that they wouldn't fall over. The Fed then stress tested those banks and forced them to put more capital in and raise it privately, whilst guaranteeing all the GSE debt. So interestingly, when the GSEs, the Fannie and Freddie, was rescued in 2008, each of them are off the US government's balance sheet by $1 of equity each. The US Treasury effectively owns 79.99999% of the common equity in each, because if you go to 80%, they come on balance sheet. But the thing that is now still going on is what we call quantitative easing, QE. And initially, in 2009, 2010, that was designed by the Fed initially, but also the Bank of England, to drive down interest rates, to keep borrowers solvent, and to effectively print money, expand the government balance sheet to keep interest rates down. It also had the nice impact of getting your currency down as well. So one of the themes of what I'm going to say is that when we've got a big debt pile built up that hasn't been resolved, the unwritten or unspoken desire of central banks is really to have inflation get rid of the problem, because most of this debt is in fixed dollar terms. If you then have 4 or 5 years of inflation at 5 or 6%, that helps erode the real value of that debt. And so you can interpret what's going on between the major central banks, Japan, Euro area, UK, and the US, as central banks trying to get their exchange rates down, to get inflation up through import prices going up, and to try and get rid of their debt burden. This would work if it was only one of these economies in trouble. The problem is this is now a global problem because each of these areas are have similar debt problems. And so it's not working for any one of them very well because they're each in the same boat. I'll talk a lot more about QE as we go along, and you can ask questions as well afterwards. So the bottom line is that the authorities had to become both financiers and providers of liquidity of last resort. The private sector had overextended itself, didn't want the risk, the credit risk, from households, subprime mortgages, and so on, and government had to step in to provide guarantees or the liquidity to prevent the system collapsing. QE, quantitative easing, effectively boosts asset prices, not raises inflation. For various reasons, it's very difficult at the moment to generate inflation like we had in the 1970s. And so what is happening is that as the Fed buys, at the moment, $85 billion of securities a month, just let that sink in, that's over $1 trillion of money being printed to buy treasuries and mortgage-backed securities a year. That money then is forced into other bonds or equity prices. So my friend Dale, who invited me here, says, the Fed's printing so much money, where's the inflation? Well, the inflation isn't in retail prices. The inflation is in asset values. It's in the stock market. So it's no surprise that yet again last week the stock market, the Dow, hit another historic record because the Fed is expanding its balance sheet so much and forcing money into these assets. So this is just a chart describing some of that. So the red line is the Fed funds rate. This is the official policy rate that the Fed operates at in the money markets. And as you see, by 2009, that had hit the deck and is just going along at about 25 basis points, 0.25% for the last 4 or 5 years. The green line is the 10-year Treasury bond yield. So that's the main driver of mortgage rates that are priced off that. So that's always higher than a very low money market rate because what we call the yield curve is generally upward sloping. But that has hit historic lows, 1.4 in 2012. Whilst the stock market is in blue, S&P 500, and has been driven higher. Each time the stock market declines, you see the Fed react. So the periods of green are the periods of quantitative easing. So the Fed acts QE1, comes off QE1, the stock market slips a bit, and they start again. And each time they stop printing money, the stock market slips and they lose confidence, and they have to start up again. This is more explicit correlation. This is the Fed's holdings of treasuries going up, just sort of driving the stock market. So this year, the US stock market is up 25%. US corporate earnings are up 3%. So the sort of economy is sort of flatlining, growing a little bit, but stocks are up a lot because the Fed is printing. This is just a chart of the different central bank balance sheets relative to the size of their economy. Japan started at a much higher level. They're in green because they've been doing this for the last 20 years to address their debt problems, and has only just started to really hit the gas in terms of quantitative easing. So from April this year, the new Japanese government effectively got the Bank of Japan to buy 3 times as much in terms of government bonds for the size of the Japanese economy as the Fed is printing and buying. So the Japanese have just floored it in order to try and get their economy out of its funk. If it carries on at the rate it's going, the Bank of Japan's balance sheet will be the size of the Japanese economy in 2018. The US is, as we say, carrying on in blue. The red is the euro area, provided a lot of additional liquidity in 2011, 2012, as euro area banks were in trouble, concerns about euro area breakup. They've been paying that back, and so the euro area's central bank's balance sheet has been shrinking as a result. So where are we now after all that? The main backdrop is that we're still holding near record levels of debt across the economy. I'll just show you the next slide, which is the really scary historical side. This is, if you add up all the debt of government, households, banks, and corporates in the US relative to the size of the economy, this is what you get. And so it, for the last sort of 150 years, peaked in the 1930s at just over 300 times the size of the economy, then came down in the Second World War as a result of inflation and strong growth, started picking up a little bit in the 60s and 70s, but accelerated fast from the beginning of the 80s, because we decided in our wisdom, Reagan and Thatcher, to deregulate the financial system, to make credit easy. And as a result, debt started mounting very rapidly, both US and UK, and we're now at over 380%. The sort of interesting thing is that US households over the last few years have actually started to get their debt levels down, both through paying off their mortgages as they just amortize those. That's as you make your normal mortgage payment, some of that goes to interest and some of that goes to paying off the principal. And so that's been going on. But also some of it has come down because of foreclosures and short sales. So when a house is repossessed, there's usually a loss that is absorbed by the lender. Now that may be a bank, but often it's the whoever's holding the loan, and that's often a mortgage-backed security trust. So this sort of strange thing is that while securitization helped sort of cause the crisis because it relaxed credit standards too much, it's helped spread the loss around the system and allowed US households to get some of that debt down. However, at the same time, government debt has just gone up very rapidly as a result and sort of compensated for households getting their debt down. The other main thing to realize is that this is the slowest recovery of the US from recession at any time since the Second World War. So this is what you normally get when you have a big financial crisis. The system becomes disrupted. The cost of capital goes up sharply, and therefore the loss of output is much more severe than a normal recession. Interesting, I haven't got a chart to show you, but if you looked at US GDP, it goes up in a sort of 45-degree line before the crisis, then drops and resumes at a sort of 30-degree line, and that drop of output has been the strongest since the Second World War. I'll just show you a chart of that. That's just, if you take the bottom of the recession as 100, and every recession since the Second World War, the thick blue line is where we are on this recovery. And then just to note, we've had the lowest interest rates, as I said, in history to keep this debt burden from crushing the real economy, whilst we've had massive monetary and fiscal stimulus. What's happening to US jobs? This is a chart just reinforcing that last point about this being the deepest recession since the Second World War. What normally happens in a US recession is you get quite a sharp loss of jobs, maybe 3-4% of employment in the economy. But after 12, 24 months, you've generally got back to where total employment was before the recession. Unfortunately, we're in this recession is the red line, and so we're still 4 to 5 years since the recession started, since the crisis hit, and we're not yet back to total employment levels before that. That is unprecedented since the Second World War. This is what's going on with the unemployment rates. The black line is the rate you hear quoted as what the unemployment rate is. That just ticked up last Friday to 7.3%. The red line is the very broad measure of unemployment, which would include people on part-time work that want full-time work, discouraged workers, and others who are sort of trying to find more hours but can't get them. The true underlying rate of unemployment on an internationally comparable basis is probably a little higher than the black, maybe about 9%, because this recession has seen a lot of transfer from unemployment benefits into disability. But this is what's quite worrying for economists in the US. The top line is the proportion of the population that is either unemployed or in employment. So there's a lot of discouraged workers who have just dropped out completely. So the proportion of the population in the US that is employed or looking for work is as low now as it was in 1978. So you see the reduction in the unemployment rate is as those two lines compress. The employment ratio is marginally edged up, but we've still got a problem that the participation rate is falling. Therefore, people are dropping out and not counting as unemployed. Just to also reinforce that this is the number of long-term unemployed people in the US over 26 weeks. So this is people claiming unemployment benefit after half a year. And that has dropped a little bit, but still very elevated relative to historical precedent. So the bottom line on jobs is that there is a recovery, but it's very slow, and the system is still fragile. There's been a lot of switching of full-time work for part-time as well. Turning to housing, this was the problem sector that caused the crisis in the first place. If you see on both these indices, the Case-Shiller is more weighted to recent purchases and population growing states. Both of those indices grew very markedly, effectively doubled in the sort of 6 or 7 years before the crisis. You had in terms of Case-Shiller, a 40% fall in national house prices, and that's picked up maybe about 15% since the bottom in the last 18 months or so. Some indications that US housing has softened in the last few months because mortgage rates have picked up recently. Why is the system healing itself? Well, this big backlog of delinquencies and foreclosures in the system is gradually being worked through. So at the peak in sort of 2010, you had around about, I think it was 7 million either mortgages in delinquency or foreclosure to come. And that sort of the shadow inventory of housing has been gradually being worked through as interest rates have stayed low, as there's been some recovery of employment. However, the main problem is that the system is still almost entirely dependent on the government to guarantee mortgages. Sorry about this. So this is just the number of mortgage-backed securities that are created each month. And the green at the bottom is the Federal Housing Administration, and most of the blue is Fannie and Freddie. And so they are still doing nearly all the mortgage sort of guaranteeing and securitization that is going on. The system just hasn't healed itself. Banks don't want to lend and hold the mortgages on balance sheet. Other forms of credit haven't substituted. So 90 to 95% of all mortgages still in the US have some form of government guarantee on them. They're not freestanding, as it were. Coming on to the banks, the irony here is that the banking system has recovered relatively rapidly. So this is the quarterly earnings of the total banking system. And as you see, 2008, 2009, lots of losses were being booked through as banks were having to accept write-downs on their loans. But because interest rates are at very low levels, but banks are able to charge significant amounts for credit cards or other loans, they're earning quite a fat margin now on the loans they've got on their balance sheets. And so quarterly profit for the US banking system has recovered to a record level. This is also the case with capital that the banks hold relative to the size of their balance sheets. American banks have traditionally always held more capital than European banks because they are more tightly regulated. They take more risk on their balance sheet and hold fewer government bonds, but they hold more capital on balance sheet. And that has recovered much more rapidly than in Europe. This is one of the reasons why the euro area is still struggling to come out of recession, because many of the banking systems are trying to raise capital, and that means cut the risky loans that they're holding on balance sheet. So if you were to go to Spain, I still sort of amazed when I see the Spanish credit numbers come through each month. Total credit to Spanish corporates from Spanish banks is shrinking at 20% a year at the moment. Spanish banks are trying to heal their balance sheets, reduce their risk so much that they're tightening that fast. However, in government finances, this is where we saw a lot of sort of compensatory borrowing as the private sector got into trouble and wanted to save more. So in terms of the size of the government deficit, what has gone on in the last few years has been as if the government were fighting a war but weren't fighting any battles. They were borrowing more than they have done at any time in peacetime relative to the size of the economy. At one point in 2009, 2010, the US government was borrowing over 40% of what it spent. And so that was, in peacetime, that's been by far and away the largest amount of borrowing ever done. And this is sort of just illustrating the size of revenues and spending relative to the size of the economy, and obviously the gap between them is the size of the deficit, how much has got to be borrowed. And as you see, in 2000, there was a brief period of surplus, but then that exploded, the deficit exploded in 2008, 2009. Revenue has recovered somewhat since then. Spending has been brought down, partly through unemployment benefits coming down somewhat, but also spending cuts being applied. To note, however, the CBO just says it's likely that revenue flatlines on unchanged policy at about 20% of GDP, but soon the retirement of the baby boom generation really starts putting sort of lift under both Social Security and Medicare, Medicaid spending. So on unchanged policy, there's a big structural deficit that the US is going to start running. The good news is that the deficit this year has closed a lot quicker than people were expecting. So last year, the US ran a deficit at almost 7% of GDP. This last financial year just finished, that tightened to just over 4%. And so that was a very sharp decline in the deficit and much quicker than most economists expected, partly because of the sequester cuts coming in. And even though they weren't meant to happen, they did, and that has tightened spending a lot more. But you'll notice the CBO are still sort of suggesting that the deficit will continue to tighten to around 2 to 3% of the economy and then start rising again. This is their long-term projection on the US federal debt. As you see, a little bit of a peak and coming off that in the next few years, but then that structural deficit starts kicking in and the debt rises again. And after 20 years, you get up to debt to GDP of over 100%. And that's, just to put that in context, Greece at the moment is at 170%. Portugal is at 130, Italy is 130, Spain is about 100 at the moment. So what have we learned from the crisis? As I've suggested, what we've learned both from Japan's crisis 20 years ago, the Scandinavian crises of the late 90s, but this also is that finance can really mess up an economy. That when it hits, you get a much bigger disruption to real output than most economists expect. But also because it's a financial crisis, it sort of happens somewhat out of the blue. Because financial systems look safe for a while, people get complacent and then they jump to default. This can produce a much bigger downshift than people expect. We've learnt that because we're carrying this massive debt burden but haven't wiped it off in some way, haven't reduced it with inflation or with bankruptcies or properly moving debt into equity, then we've needed to maintain stimulus for a long time. So if you'd asked Chairman Bernanke in 2006 what would happen to the economy if the Fed's policy rate was at 0, the government was running a 7% deficit, and the Fed was buying $1 trillion of assets a year, he would have expected GDP growth of 6, 7, 8%. That's the amount of stimulus you would have thought would have generated. That amount of stimulus would have generated. But because we've got this dead weight debt burden that is undermining confidence and reducing our willingness to invest and consume, we keep needing masses of stimulus to just keep afloat, keep the plate spinning. As I said before, inflation is difficult to achieve when other countries, other major trading blocs are in the same boat. So each of these countries are sort of trying to import inflation and export deflation to each other, and that can't be done globally. And so each of these central banks have to compete with each other to get their currencies down. Government, as we've seen, becomes the guarantor of first resort in this crisis. So, as we've mentioned, as the private banking system and Wall Street didn't want to hold these risky assets, couldn't fund them, then either the Fed, the FDIC, the Treasury, or whoever has to come in with a big cushion of guarantees, of liquidity, of stimulus to take that risk from the private sector. And we're still working through some of that. That, as I said, the mortgage system in the US has not healed. The private sector doesn't want to take mortgage risk. Securitization has been both villain, causing the subprime crisis, but hero in the sense that it's allowed those losses to be spread around not just the US system, but globally. The interesting thing is that a lot of the losses from subprime mortgages have been paid for by UK taxpayers because Royal Bank of Scotland, Lloyds Bank, that have been nationalised, have had a lot of that stuff on their balance sheet, and so UK taxpayers have been paying for US mortgage delinquencies. You're welcome. And then to some extent, the US has been saved by the dollar's reserve status and its improved trade position with regard to energy. So the US generally benefits by about $100 billion a year because foreigners are stupid enough to hold treasuries that don't yield that much. And so foreign central banks and governments issue debt in their own currencies or in dollars that are quite expensive, and then buy US treasuries that yield much less for the insurance that they get from having foreign currency reserves, and treasuries are still the main foreign currency reserve. Around 50% of currency reserves are held in dollars, a little more than that. So if this crisis had struck in any other country, what would have happened would you would have had a strong capital flight from the currency and bonds, because the ability of government would have come into question if it was starting to run deficits as large as the US was running. That didn't happen, particularly in the US case, because a lot of its debt, around half of treasuries, are held by foreign central banks who want the dollar as the reserve currency in their portfolios. So they're sort of locked in, they're captive investors that have been exploited and weren't able to flee in this crisis. Also, the US current account deficit has been coming down quite rapidly because of the change in energy production in the US. So the US is now the world's largest oil producer, and that is closing your current account deficit quite significantly. It's perhaps no surprise that relationships with Saudi Arabia at the moment are deteriorating. Whether there's correlation or causation with regard to becoming the world's largest oil producer is for others to speculate. But the US has certainly been saved from the more extreme consequence of the crisis because you have your own currency and it's held widely abroad, and foreigners are sort of locked in and can't sell that easily. What we've yet to learn, however, this is where it gets personal, is that for a moment in 2009, 2010, there was a sort of soul-searching, both in the US, UK, and Europe, as to does this financial system work? We've taken quite strong measures to get more capital in banks and regulate them more, but we haven't broken up any large banks, certainly in the US. We haven't put a banker in prison in the US, even though we now seem to have every week banks being fined for manipulation and fraud. So they are doing things that Enron did 10 years ago, but there still hasn't been any criminal charge brought against an individual on Wall Street. And we haven't moved away from this idea that having high levels of debt to finance assets is the way to go. So there's still no fundamental questioning of whether this model is the right one that we should pursue. We think that, if we regulate it better, if we are more careful, next time it will be different. We won't have the fire. We can operate our fire engines well and so on, and we'll cope. And I'm afraid we're just, because we haven't got the imagination to think more seriously about, is this the right form of financial system? We're not thinking radically yet. I'd say that this is just the end of the beginning of the crisis, in the sense that the big debts are still piling up, but we're not counting them yet. And I'm going to show you some very scary slides about the unfunded liabilities of the US government and state and local government. In that, the US government counts on balance sheet about $12 trillion of debt held by the public. But if you count all the other liabilities that it has guaranteed or made promises to that hasn't been funded, that would be around about $70 trillion. If you take the annual reports of the Board of Medicaid, Social Security, the guarantees to Fannie and Freddie, the guarantees of bank deposits, and so on. So the US taxpayer has effectively guaranteed or unfunded $70 trillion of liability, but only admit to, on balance sheet, 12. A controversial point in a tertiary education institution is I will also say that part of our problem is that we are becoming a sort of debt slave society. Not just the US, perhaps you're a little more advanced in this than the UK, but we're certainly going that way. And this is a big generational issue, because as the baby boomers retire, they have got government to promise them a lot in terms of healthcare and pensions. They've enjoyed high house prices that are starting to rise again. And yet we've got younger workers, younger households who can't afford high mortgages. They're coming out of college with multiple thousands of dollars of debt, and so are being sort of indebted early on, and therefore being compliant in this system early on. And the sort of first taste of that is indebting oneself for college education. One of the issues around why the recovery hasn't been strong and what that debt slavery is doing is that there is growing inequality in the US. So I'll show you a chart in a moment that puts income inequality at the US now higher than it's ever been. So it peaked previously in the late 1920s, but then has grown up back up to exceed that level. And in one sense, that's why economic recovery is so muted, because most households in the middle are still heavily indebted or not feeling very rich at all. They're not getting real wage increases. And most of the gains of economic growth are going to the top. That's why mass consumption is still very muted. And then finally, I'll say something a little bit about why governance of politics in the US is a serious problem and is here to stay. So just a few charts on those points. This is just what's going to be projected to happen to US government spending. And you'll see that it's Social Security to some extent, but mainly medical spending that is going to drive a lot of the growth. But also because the system, the government is now much more indebted than it was 2 decades ago, that interest bill is going to start rising, even though the CBO assumed that interest rates are going to stay relatively low. So I think it's by 2020, even with interest rates at low levels, you're going to spend more on interest as a government than on defense, but will rise from there on. Part of the problem with the indebtedness of government is that at state and local level, the funding of pension obligations has been far too optimistic. So this is what brought Detroit to bankruptcy as a city. The shocking statistic is that the pensioners of Detroit are going to receive 16 cents on the dollar once it comes out of bankruptcy. It had overpromised that much. But this is not just a local problem. This is an endemic problem to the US at state and local level. Officials generally undersave relative to the commitments they make to teachers, firemen, and so on. I'm afraid New Hampshire, although not the worst, that's Illinois, but in terms of, I think New Hampshire is the 5th most underfunded state in terms of pensions obligations. So I think you're just over 50% funded on your pensions. Illinois is down at 42, I think. But if you add that up, there's probably $2 to $3 trillion of underfunded state and local pension commitments to make. And then this is just a chart from Morgan Stanley trying to do a sort of a long-term, a generational debt profile across countries as to how much each government has promised but not funded. And I'm afraid, this was 2010, the US of major countries is in Europe, and the US is somewhat sort of the worst. I'll have to say that since then, Ireland and Greece have done a lot to address their deficits, and so they'll be somewhat more to the left. And so the UK, the US, and Japan stand out as governments that are still running structurally large deficits and haven't really addressed them. This is just to underline the point about student debt. We generally think that the major bubble in cost in the US has been medical care. If you actually look at, certainly for the last 30 years, what has inflated most in terms of cost in the US, it has been college tuition fees. So this is just the growth in the last decade of public schools and private. And just to note, you've had a 50% rise in private school fees and over 50%, sort of more like 80% rise in public school fees. Inflation across the economy during that time would be in about 20%. So you've got tertiary education becoming very expensive, and I would argue that that's being facilitated by easing credit standards. So we've just had US student debt has exceeded $1 trillion for the first time. Most of that now, nearly all the new lending is federal student loans, because the government has decided to subsidize student lending so much that no private lender now thinks it's worth their while. So all the new lending has been federal. The shocking statistic is that of the loans that should be being paid back, a third of those are delinquent. Just let that sink in as a taxpayer. A third of the loan book that you've lent out to students is delinquent now, even with interest rates at low levels. This is just a chart on income inequality, what the top 10% get of the share of income in the distribution. And as we see, that peaked in the 1920s at just under 50%, but has now gone above 50% for the first time. So that's the income share of the top 10% get 50% of the income. And this is what's driving that. Productivity is still going up, although that has slowed down somewhat, so that's real output per hour in the US. But the compensation, wages, have pulled away from that in terms of growth since sort of mid-70s. That's partly as a result of the undermining of unionized labor, but also mainly the result of the globalization of the labor force. So unskilled and low-skilled workers have very little market power in a global economy, and so that labor share has been falling, even though productivity has been going up. So effectively, capital has been taking that gain in productivity. And for the last 10 years, that's just a line of where the labor share of income has been falling. So roughly, it's lost about 9% of the economy over the last 13 years. This perhaps is the sort of most depressing chart, very simple, but this is the median real household income in the US. So this is the representative middle of the distribution household. And we're back down to real income as was at the end of the 1980s. So effectively, even though the economy has grown roughly 25% in that time, the median representative household, once you take into account price inflation, is back to where we were under George Bush the First. So this is just a chart of who owns which assets in the US. The middle class, the 20 to 80%, that's the middle 60% of the income band, primarily holds their assets in housing, a little bit of cash, some pension, and so on. And obviously, the wealthier you get, the less your primary residence counts as part of your wealth. But I think the thing to notice is the red line, which is the debt-to-income ratio. Now, I was telling you that US households have been paying their debt back, that that ratio has been falling across the economy, and that's true. But always look at the distribution of where debt is. Economists often make the mistake of just taking national data and thinking that applies to the majority of people. The problem is that debt is highly concentrated across our societies. And what's been effectively going on is that debt is concentrated in that middle class. And if you see the debt-to-income ratio is over 150% for the middle, much less for those at the top of the income scale. In a sense, that's why you're still not seeing widespread increase in consumption, even though interest rates are at very low levels. People are still trying to pay off debt, save to do so. Why, when you're faced with this crisis, is US politics not helping? Well, these are just two charts on what I would say is the reasons for why you're not getting compromise in Congress. Just from an outside perspective, what is happening is that through partisan redistricting, congressional seats are becoming safer for the parties. So they are effectively agreeing with each other to redistrict so as to produce safe seats, both Republican and Democrat. And so for those congressmen and women, the main contest they're going to face is not the general election, where they have to appeal to the center, but their primary, their party primary. And so they have to appeal to get their seat to their extremes, their base, rather than compromise and think about what will appeal to the center. So you'll see that both Republican and Democrat safe seats have been trend rising, whilst the marginal seats have been falling in Congress. And there are very fewer and fewer contestable seats due to redistricting. You're also finding that because of campaign finance rules, now both trade unions, other groups and corporates can contribute to campaign finance campaigns, and effectively fund extreme candidates from both sides who want to do the bidding of a funded special interest. So what's happening is that this is the sort of moving to the extremes in terms of voting record. So in the late 60s, you did have, obviously, Democrats and Republicans having the two peaks of voting record on a range of liberal or conservative issues. But there was still a reasonable overlap between the two. So on some issues, you had blue dog Democrats voting conservative, some Republicans voting more liberal. And so there was some partisan cooperation and overlap. Voting records in the previous Congress at the end of the last decade showed that there was virtually no crossover voting because both parties are effectively appealing to their base, not thinking about what will go well in any general election. So what's going to be the upshot of this? I think just to close, this is the fundamental problem the nation has in averting this bigger debt crisis that may be coming. Because, as I said, the financial crisis has sort of been tamped down. It's through major stimulus and so on. It's been the sort of sparks have been put out somewhat at the expense of making big commitments and accumulating large amounts of debt that is going to weigh on future generations. What it needs is a bipartisan agreement to address some of that gap between future spending and future tax. That means entitlement reform and tax reform to both make the tax system more efficient and to increase the tax take. And from an outsider's perspective, it doesn't take that much to close that gap. The problem is your governance system is now so dysfunctional that it's difficult to see how you're going to make that compromise, because it means that the extremes in terms of entitlements or taxpayers are going to both have to bear a fair amount of pain to reduce that gap. But your political system is showing it can't produce that compromise. Now, what will happen, what's likely to happen is that, as Winston Churchill says, you can always rely on Americans to do the right thing after they've done everything else beforehand. So it will need an existential crisis to force that compromise. How that occurs is difficult to foretell. It may be that this just recent debt ceiling and government shutdown episode probably was the sort of turning point in international sentiment about holding dollars and treasuries as a reserve currency. Because it showed that this problem is not a one-off thing that will come up every 20 years and there's a government shutdown. It's more of a structural problem in the US system. And so you won't find a mass sale of treasuries by foreign central banks and interest rates shooting up and the dollar plummeting, because this thing happens very slowly. Central banks change what they invest in very gradually. And there aren't that many alternatives to the dollar as a liquid reserve currency. But I suspect what you'll find is a gradual edging away of foreign holders of treasuries as they realize that this is a long-term problem. And then when we do have another flare-up, another crisis, that safety net of foreign buyers won't be there, and interest rates really will go up heavily, strongly in the US. So I'm trying not to end on too gloomy a note. My main message is it's fixable, but thinking of the process of how to get to that fix is very difficult. Thank you. So if you can go to the microphone, I think, for questions.
Thank you, Dr. Mills, for a great presentation. This is a global crisis, and I've read that many countries are starting to hedge with gold. They're buying tons and tons and tons of gold and putting it away. Where do you see that for us and for the American economy? Because we don't know how much gold we have. Thank you.
Well, I think the Federal Reserve says it has around 3,000 tons. There's a little less held by the IMF, but that's in Fort Knox as well. So in a crisis, you might get that. Gold has risen in dollar terms strongly since it bottomed out in the late 90s. So the lowest point was around $250 an ounce, I think around 2,000. And it rose last year, peaked at about $1,800 an ounce. It's now down to just below $1,300 an ounce. So what's gone on is, why did gold rise in value so strongly? There's two reasons. Partly it's a safe haven hedge for inflation, as people were concerned that with all the central banks printing currency, there's going to be too much currency around, that must be inflationary. Also with euro breakup as a risk, up until the middle of last year, there was a concern that gold was a hedge against that. But also there's been a reallocation of investment funds from pension funds and others into commodities, because they've thought that the capital gain on commodities and they're acting as a hedge against other risks from other investments was worthwhile. And so you had quite a strong appreciation, not just in gold and silver, but also wheat, oil, etc., as money was structurally invested in commodity stocks. That's come off somewhat because the inflation worry hasn't materialized. So whilst I'd say there's inflation, it's in stocks and bonds, it's not in real goods and services. The euro is held together, so that's cut some of that demand, but also the sort of leverage chasing of capital gain has stopped, and so you're seeing quite a lot of liquidation from hedge funds and exchange traded funds in commodities because those capital gains have stopped coming. There's some concern that interest rates were going to rise in the US, so that brings commodities down. So I'm not going to call the gold price. I'm no good at market timing and so on. But an element of that speculation is now out of the price. So I think the cost of digging it out of the ground in South Africa or wherever is around $900 an ounce. So it's you've still got some supply going to be maintained, and that may be sort of we're going to be sort of plateauing at this level. I'm not sure. Should the US sort of start buying gold like other countries, whilst in one sense it's got this exorbitant privilege, as the French have called it, of the reserve currency, you don't need to. But if you were to fear that will go away one day and you do need some more backing to the currency, then it might be worth thinking about it as a hedge to risks of the breakdown of the global economy. However, to be honest, there's not enough gold physically in existence to even conceive of going back to a gold standard, for instance. So even if you were to advocate going back to a commodity standard to sort of back just the base money across the system now, the gold price would need to be sort of 10, 15 times higher than it is now. I mean, it's just not feasible. So if you were to reintroduce a commodity standard, you would have to include other commodities, silver, wheat, oil, and so on, and have a basket. So other countries are stockpiling gold. India is trying desperately at the moment to stop its citizens buying gold. So it's taxing imports dramatically. It's effectively penalizing people for importing gold because of the concerns about their currency. So there's a lot of retail demand. The Chinese central bank is gradually accumulating gold reserves as well. But the US and other countries have just sat on the gold that they had when Bretton Woods broke down in 1971. So the US holdings are pretty much unchanged from then, around 3,500 tons. Now, I've got a question there. Mike?
I'd like to ask you about a scary slide that wasn't in your presentation.
Oh.
Maybe you can add, and that is excess reserves. It seems that part of why the Fed is engaged in QE3 is because traditional monetary policy can't work if banks don't lend, and we've gone from historically zero excess reserves to, what, 1.3 trillion or so now. What happens when banks want to start lending that money again, and how do you think the Fed is going to deal with that issue, and how does that play into your whole inflation story?
Well, the banks are holding excess reserves partly because the Fed started paying interest on them a few years ago. So the banks get 25 basis points on the reserves. They only get, if they're holding a treasury bill, they only get 7 basis points at the moment. So they're holding those reserves voluntarily in the Fed. They could be using them to go into other things. But it just underlines that banks aren't limited in their lending by reserve requirements. That's not a binding constraint and hasn't been a binding constraint on how banks operate since the 1970s. So if you've been brought up with your textbook economics around fractional reserve banking, and there's a reserve requirement and the central bank can just squeeze reserves and banks have to stop lending, that's not how it works. Banks are driven by capital, not reserves, because they can either borrow reserves easily or generate reserves through how they manage their liquidity. So it's very, very rare that reserves actually become a binding constraint on a bank balance sheet. What they're most driven by is their capital and whether they can generate a rate of return on equity that's going to satisfy their shareholders. So how a bank thinks about whether it's going to make a loan to you if you're a small business is that it will think about the margin it can charge you on, say, if it's borrowing from the Fed at very little, or the money markets at very little, and can lend to you at 6 or 7% as a small business. That sounds like a good deal. It's making a leverage return of 5% and can lever that up. But it's got to put capital aside, and its risk weighting on a small business loan is very high, because small businesses are risky, aren't they? So it's got to generate a rate of return on its equity to justify holding that small business loan on its balance sheet. It's not constrained by can it generate the cash to do that. So in terms of excess reserves, I'm pretty confident that the Fed will have the tools to extract excess reserves if it wants to, because you can do that. It's already testing a tool called a reverse repo, where it's going to put collateral back into the market and suck liquidity out. And it's been testing its instruments for when it finishes QE and starts thinking about, right, I'm going to start raising Fed funds rate. That's not their problem. Their problem is that they're pushing lots of stimulus, but people don't want to borrow and consume. And it's this pushing on a string. The system is awash with liquidity, but as we've said, there's no inflation because there's very muted demand because balance sheets are still impaired. Hope that's answered that. Do you want to go to the microphone?
No, I think
Okay. Okay.
First of all, the West and the Blue Twice to one of my great heroes, and Winston Churchill. And the question is this the end of the beginning? So let's go back one slide.
Okay.
I'm a businessman, and been in the financial services industry. Very long, slow climb out. We're not sure we're out of it yet. We're almost waiting for another dip, especially with the Dodd-Frank Act coming in, with the real nuts and bolts of costs of doing business. So that's number one. Number two, this is a lot to absorb. Can you get your slides online?
Sure.
And number three, about the banks. We talk about their income going up. Where are their stock prices relating to their income streams? Because it seems that the bailout, the Dodd-Frank, has been essentially a gift to the big banks. The big banks are not doing very well. As a small businessman, I get that. We understand that, if the banks fail, we're back to 1932. We're probably very close to 1932. Going back to not 08, but probably 06 or 07. You're the first person I've ever heard publicly state, the first person, prominent public individual in the state that knew this might go back to 06. Have we reached the point now where we're coming out of what could be, not the Great Recession, where 50 or 75 years from now we'll be talking about the Great Recession or the Great Depression? I'm not sure. So those are three things thrown into the one hour.
So in terms of the end of the beginning, I think what I'd say is that after 5 years, the sort of financial system is not going to be the independent generator of the shock. It's generally healed enough. Now, I'm no doubt going to be proved wrong that all of a sudden there's a rogue trader that's going to take down one of the Wall Street banks and cause a problem. But in terms of the leverage and the mismatch that's gone on investment bank balance sheets and banks themselves, that has been largely addressed. So banks have got a lot more capital. The Fed is cracking down much more on the liquidity mismatch. We've still got a big problem in terms of we're not sure we can resolve a big bank. So if one day it was realized that one of the big Wall Street firms was insolvent, would the authorities break Dodd-Frank and bail it out because they're too scared of what would happen? Now, Dodd-Frank says they can't do that. The difficulty is that investors, I think, will think that they'll find a way still, because to resolve Citigroup or JP Morgan or whoever is a monumental task. So I think Lehman Brothers, when it went bust, it was 16,000 legal entities. Citigroup is multiples more complex than that. So we've still got, to my mind, we've still got a long way to go in terms of doing what we should do in terms of bank size, too big to fail, and so on. But in terms of is there more capital in the system, is it much less risky, I'd say that we're getting there or thereabouts. The problem is more that we've got this structural issue of the debt overhang that's both government, households, and corporates. Now, I haven't really mentioned corporates, but US corporates for the last 18 months or so have been borrowing heavily, partly to buy their own stock back, but not to invest in capital. So one thing I didn't mention, and is in one sense an upside for the US, if you get confidence back, is that capital expenditure is very low on the corporate side, and it is at record low on government side. So you're doing very little infrastructure investment, investment in buildings, plant and machinery, and so on. So there's a lot of pent-up demand and good projects that could be funded if there was confidence to get finance into them. The problem is that even with interest rates at very low levels, companies and individuals just aren't wanting to do that. They're still trying to address the debt problem. So this is my sort of big perspective, is that the financial system itself is safer, but we haven't resolved the underlying problem, which is the debt side. In terms of sort of what's going to happen in the next in the short term, a lot depends on what the Fed does with QE. And this year has been instructive in that it thought the recovery was gaining ground, talked about reducing stimulus in June, and all of a sudden interest rates went up quite a lot. Mortgage applications halved, and all of a sudden they backed off, partly because they were worried about the debt ceiling, but also because all of a sudden they were worried about the impact of mortgage rates going up so much. So they're stuck in this, as an analyst put it in the UK, they're in Hotel California. You can check out, but you can't leave. They've tried to check it, well, they've checked out, but they're still there. And whether the recovery is strong enough for them to maybe start tapering in March is the general expectation. But it may be that when it comes to it, the recovery just isn't strong enough for them to do that. I think that they will do something next year because they're just getting too big relative to the markets that they're investing in. So they're starting to own more than half of the interest rate risk of mortgage-backed securities in the whole market. They're starting to own more than half of some treasury stocks. The Fed, as it's buying in, they are the market, and they're deeply uncomfortable of that, and they don't have the legal ability to buy anything else. So the Fed Reserve Act limits them to only things that are guaranteed by the government. They can't go and buy corporate bonds, covered bonds, stocks. So they're becoming bigger and bigger relative to the market they're buying, and that's deeply uncomfortable for them. So they're caught in this limbo, and we'll see what happens to interest rates as they stop the stimulus. And it could be that interest rates on mortgages start going up to 4 or 5%, and then you may see a softening in demand as house prices start falling and housing activity comes off.
So, and then my other question, how do we get your slides? That's a lot of stuff to absorb.
Yeah, I think these are all sort of public. This is all public data, so I think we can put them on a website with the video. So
we just get to the 3 questions we have
okay.
here. Okay, great.
Well, my last one, and this may be the economist, the correlation between the bank earnings and stock prices of banks. Where do you see that right now? Do you see those banks being healthier in terms of their balance sheets and their stock prices as opposed to right now?
US banks have, in terms of stock valuations, have recovered much quicker than European banks. So how you value a bank stock is usually, if the market's got a lot of confidence in the bank balance sheet, what's called the price to book value, so the value of their total market cap versus the value they claim of their book tends to be above 1, and that's been healthily so for the US banks for, I think, the last year, 18 months. So the market has restored its confidence in banks. The issue is not that the banks are risky, it's that they're not taking on risk for the private sector, for the economy. The bank balance sheets are being managed to sort of keep the stock price high for their shareholders, not take risk for the economy. So in terms of are they healthy, they're certainly healthier than European banks, and no doubt there's losses that will still need to come out, particularly on commercial real estate, but that the sense of crisis certainly has gone in terms of, we don't know how to value a bank's balance sheet in the US. Investors are much more confident about that, partly because of the stress tests that have gone on.
Hi. I've got a rather simplistic understanding of a national debt, in that we spend more money in checks to people and things we buy than we collect in taxes. And I understand, I guess, over the long term, that is a problem. What I don't understand is how the Fed's quantitative easing and buying $1 trillion a year worth of stuff contributes. Does it add to the debt? And does it have any downstream bad effect to keep doing that, or to keep interest rates at 0?
Yeah, so effectively the Fed is buying things that are already counted as government debt. So they are swapping a treasury security in the market for a bank reserve on their balance sheet. And so, yes, you can say that they're printing cash to buy in government bonds, but that cash is another type of government debt. So the Fed's operation is largely, I mean, this is not entirely correct, but broad brush, it's neutral with regard to is the debt level rising. What is happening is that they are funding the debt held by the private sector is much shorter maturity. So they've effectively switched a 30-year treasury that's in the market, bought that in, and they've substituted it for an overnight deposit or a short-term deposit with the banking system that's a liability of the Fed. Now that, whilst interest rates are higher at the long end than the short end, that is a profitable thing to do, whilst you can hold interest rates down. And so the Fed is actually saving the Treasury quite a lot of interest at the moment, and the Fed is giving the Treasury a big dividend in the interest it's saving. The problem is that if and when they decide to start raising interest rates, that's going to ripple through to interest rates across the yield curve. And so the treasuries that they are holding are going to fall in value quite significantly. So a lot of that dividend that they're giving the Treasury may well have to be sucked back out of the Treasury to recapitalize the Fed, if that gets out of hand. So it's not that what's quantitative easing is adding to government debt. It's shifting it from long-term debt of the government to short-term debt. And that is, at the moment, is generating an income saving, but it is risky, because if interest rates rise sharply, it's going to look bad. It's going to cause the Fed a big loss. I hope that explains it.
I have a couple of questions. My understanding is that China and Russia are pushing for an alternative to the US dollar as the reserve currency. Do you foresee that happening?
Well, China has been sort of very, very slowly liberalizing its own financial markets, hoping to develop their currency as a reserve alternative. But they've still got quite a long way to go. So in terms of liberalizing their banking system and government bond market. So yes, some countries are starting to reallocate a small amount of their reserves to the Chinese currency. So South Africa last week said that it would buy, I think, $3 billion worth equivalent of Chinese bonds as they reallocate it to other currencies. But it's still got a long way to go in terms of, as a currency reserve instrument, you need liquidity. And the US is still by far and away the most liquid bond market and currency market. So in terms of ability to sell fast without changing the price, the dollar and treasuries is still the only, well, it is the main liquid instrument still in global markets. So this is not going to happen overnight. There's no other viable alternative that could absorb a big reallocation away from treasuries. What I was saying is that maybe last month was the sort of the straw that broke the camel's back in terms of the sentiment towards the dollar and treasuries as the reserve currency instrument of choice, that it will just accelerate the investigation of alternatives. In terms of, can you create a reserve currency that isn't linked to a government, and particularly a government debt market? That's very difficult to do. So if two countries want to get together and have a reserve currency, they can agree a bilateral currency for trade, and that you can do that as a political act. And so an oil importer and exporter can agree, say Iran might decide to trade with another country in gold or anything but dollars to avoid sanctions, and that can happen. But is the sort of bulk of global trade going to be denominated in that currency? No. So it's more around, is there a banking infrastructure, payment system infrastructure? Is it convenient to do this? And there are plenty of convertible currencies that are still used as currency reserves, but the dollar is still the predominant one in terms of investment. And I don't see that changing other than for political reasons anytime soon. But as I said, that gradual reallocation is going to start going.
Second question. Given the massive unfunded liabilities that you addressed earlier in the area of $70 trillion, and that's just going to keep on going from, looking at the populace, the aging populace, the baby boomers, there's going to be a higher demand or, increasing number of people retiring, fewer number of people, in the business place to pay for those people. No disrespect, but how can you remain so positive given the significance of those
I thought I was pretty
liabilities?
downbeat, I have to say. Well, the positive thing is that in terms of it sounds a lot, but it's roughly about 6% of GDP. Now that's still a third of government spending in the US or tax receipts. But in terms of what other countries have done recently, that's not unprecedented. So Greece or Spain have tightened fiscal policy that much in 2 years because they've been forced to do it by the Euro crisis and by IMF and EU conditions. So it's not impossible. It's just that in the US, it's hard to see it being agreed politically with your impasse of governance that you've got. And so just thinking about, well, you've got to maybe stop redistricting, put that on a politically neutral basis. You've got to reform campaign finance. You've got to probably do something on the Constitution to bring in a debt rule or something. And just thinking of the process that you'd have to go through and the bipartisan agreement that would be needed, it is virtually inconceivable that the US system could do it without an existential crisis hitting it in the face. So that's why I'm sort of is optimistic in that it's not that big a problem to fix. it's sort of feasible, and there's lots of upside that would come in terms of the US suffers from a vastly dysfunctional tax system in terms of compliance costs, complexity, the incentives you've got for companies to hold cash outside the country, all sorts of things. If you sorted that out, there could be sort of quite a big pickup in US growth relatively quickly, just from reform and efficiency. As we said, there's lots of infrastructure projects that need investing in. There's a lot of pent-up demand that could be very useful for the economy. So there's sort of upside potential if you could get governance sorted out. But I agree with you that there's this sort of backdrop of very long-term sort of, if you don't sort it out, effectively the underlying growth in federal debt is just going to start escalating.
And lastly, what's your best good news?
For the US, in one sense, it's thus far, Europe is not following the US in trying to make energy cheaper. So the US is sort of, because it's not regulating energy prices so much, and also because that you've allowed shale oil and shale gas, energy costs in the US are structurally coming down, whereas European policymakers are still desiring to put energy prices up. And so there's going to be a degree of reindustrialization onto mainland US, particularly from Europe and elsewhere, just on energy costs. So that's a sort of something of an upside. So that will help close current account deficits to a degree.
Hi, Doctor. While I was waiting for you to, or while you were addressing the other questions, you answered mine. So I just want to make a quick comment. I was acquainted with most of the charts you put up, but I'd never seen this one. Mm-hmm. And what really gets my attention is the date on the first part of the chart, 1967 through 69. Would you agree that that was sort of the, how shall I put it, the launch of what became the unfunded liabilities, Medicare, Medicaid, the Great Society, model cities, on and on? There was a fair bit of cooperation that got all of that spending ramping. Mm-hmm. And now, as we approach a Minsky moment, there's a fair bit of division as to whether we should have more or less.
Well, as we know from personal experience, there's a lot of agreement on spending money, but not much agreement on who pays. And so demographically, it's not just the US, Europe, Japan, and so on. When you've got very few older people, lots of young workers, then it's very easy to promise a lot to those current retirees and just say, oh, we'll fix the problem when it gets serious, but at the moment it's easily affordable. The problem is that Western democracies face a big issue with aging, in that the median voter, the swing voter, is aging all the time. Older people vote more than young people anyway, and so their voting weight in the population is growing over time. So if you don't address this early, then politicians don't get elected if they say we're cutting pensions or cutting healthcare. So that's why there's a sort of demographic likelihood of a hitting a crisis, a sort of something where we're going to default, or people aren't lending to us, or we've got a big downgrade, because the system doesn't operate intergenerationally. Future generations don't get votes, and so we keep wanting to put liabilities onto them and not address them. Now, part of this is having the guts to say, right, if we're making a promise, we've got to save now to afford that promise. So it's partly having a stewardship mentality of, right, this generation needs to pay its way, and if we're making promises to ourselves in the future, then we've got to start saving now or paying back debt or whatever in order to be able to afford it. So some countries manage to do this. So Australia, generally, although the previous government had a bit of a wobble, generally Australia is fiscally conservative at the federal level and says we run balanced budgets, or our objective is to have relatively little federal debt. Canada got its act in order after it had a big crisis in the mid-90s and sort of moved to a much more fiscally conservative ethos. Norway has got this huge oil fund that it saved up for future generations. It didn't have a big party for taxpayers when the oil was discovered. They've saved up over €500 billion for future generations. So it can be done. It's just has the sort of generation of voters got the honour and the principle not to think, I want goodies now and somebody else can have the problem. Interestingly, we are sort of seeing it coming to pass that the expectations of future generations being richer than the current one is cracking. So productivity growth in the US is now below 1% per year. Okay, you've then got a bit of population growth and so on, but trend growth in the US is perhaps 2%. And it may not be that future generations are going to be richer than the current one. So you've got to, that might start engendering much more of a stewardship mentality, that we can't just push the problem to the future because they're going to be much richer than us. The other solution is governments have to measure this problem, so, and measure them realistically. So not just the US, the UK and others, they don't count these promises as debts. It's all off balance sheet, and you've got to dig very deeply to find these numbers because they don't publicize them. Because of course if governments counted these things, then they'd have to do something about them, but they don't count them.
Thank you. Question and observation. Arnold Toynbee said that of all the civilizations that he studied, eventually their currencies petered out. And I'm just wondering how that's germane to, say, Western civilization in addition to the United States.
Yeah. So, interestingly, JP Morgan actually did put out a chart 2 weeks ago where it did the reserve currency of the Western trading economies for the last 700 or 800 years, and just sort of had the Portugal, Spain, Netherlands, UK, US overlapping periods of when that was the world's global reserve currency. And each currency lasted around about a century to a century and a half, and then an alternative came along. Now that was either due to inflation in Spain or war with the UK and so on, and loss of empire. So it seems to be that there's a sort of natural life of currency hegemony of about a century to a century and a quarter. Now the US probably, the dollar became the global reserve currency really, I suppose, in 1913 with and then 14 with the outbreak of the First World War, essentially bankrupting the UK. So you could say the US has had almost a century as the reserve currency. So how long it's got to go? Maybe another 25 years on that sort of historical timeline.
Wow. How can we, I think the American public is going to continue to be as delusional as they can possibly get away with without some serious aggressive education. And is there anything afoot that you're aware of to, I remember Ross Perot, as annoying as he was, years ago used charts and graphs instead of pictures of him shaking hands. And I wondered whether we could present objective information that you're trying to present here in some coherent fashion. And I'm not saying this isn't coherent, but you're dealing with a small group of people who are very interested, and it's almost like you got a swing group of people who are not interested. And after a while, the realities might sink in, but I think there's going to take a lot of aggressive education.
Yep, I agree, and I don't detect a sort of a big move to try and educate electorates on this. So even in the UK, we just have sort of headlines of, oh, austerity, the deficit's coming down, or it's not, or this is a good or bad thing, it's happening too fast or too slow. But we don't have anything really widely publicized about intergenerational justice or how big the deficit is relative to what it needs to be to balance up books intergenerationally. So in many ways, because of what's happened in the last year, the UK now is actually a laggard with regard to the budget deficit. So we're still up at the sort of 6.5% of the economy level, whereas you brought it down to 4%. But we still have lots of political battles about that's coming down too quickly, and the economy is not growing fast enough as a result, but no sense of where does this put us intergenerationally. We're still borrowing vastly too much. I've exhausted you all, okay? Thank you very much.